you don't have a stationary market. In other words, there are times that this algorithm, no matter what you do, is not gonna work. And I have found that if you pay attention to that and simpler algorithms, that it really does pay off. But what's your comments on it?
What do you mean in regards to simpler algorithms?
Do something like just use a moving average, perhaps instead of using it as above a certain, the average above and below, maybe using it as a low pass filter, and then do a momentum, which is just percent change over a certain time period, and put the two together, works real well.
Yeah.
Sometimes now, there are times it doesn't work. And that's the key. I don't think any algorithm works all the time. The market's not stationary, and that it would seem like you want to be out part of the time. Just totally out.
Yeah. So in regards to that, like when I say algorithm, I kind of just view as like some type of market dynamic trigger that triggers an execution of that. So there's a reason I have signals on all of these. So how you balance this out too is when I talk about this mechanical portfolio. The beauty of the mechanical portfolio is you sell a larger premium pool because you sell it every day. So if I can create a trade that when it loses very small, and I can sell 4 times the amount of premium that I would on a indicator from an algorithm, I need less of an expected return because the lower the premium pool, the less I have to make off that premium pool. And you can see that basically displayed here, 12% PCR, but it's traded every day. Whereas when we look at a trend following, which is your more traditional trigger, strong up market, I can't trade this as large because if it ever reverses, I would take a vicious drawdown. But the
Why
fact,
wouldn't you just get out? Why wouldn't you have something that's detect the drawdown?
because when you're basing something off of a signal and then you're using something else to base a signal to get out, you're introducing a huge amount of potential variance. So like if that works once, it could potentially half my drawdown. But if it keeps me out 3 or 4 times, then it could really screw up my positive,
So why don't you just improve your algorithms to detect the drawdown?
because then I'm constantly improving it and then I'm just introducing more and more sequencers. Because at what point do we stop optimizing it? So even this trend following is the signal has not changed since 2020 because I balance this with a long short overnight strategy that's based on delta and then a credit targeted everyday strategy. I'm basically not looking for this to be the whatever miracle. The goal of this, more so of the trend following, is that I know this wins when my mechanical loses. So this is almost like a quasi hedge. I'm just using it from a short premium. So I would say it is kind of built in, but I built that on these signals offset the mechanical very well rather than optimizing these to do best. Because in terms of not trading and improving, there's also a huge benefit to offsetting one another as well.